I like Graham Stephan a lot. I think he makes great videos. In this video about the melt up, there are several things in which I agree with, but I don't think he looks at it from the longer term perspective. I think a lot of data points here are cherry picking, and that's not a critique on Graham Stephan. That's just the way we are in this world, and we talk about that with investing. So let's go watch this melt up, and I will show you my thoughts along the way.
What's up, you guys? It's Graham here. So this changes everything. I know this might be hard to hear, but there's a growing realization that the stock market's not going higher. It's just the dollar getting weaker. And when you look at the numbers, they're not exactly wrong. For instance, despite record high market growth, you would actually be negative for the year when you account for how much the dollar is quickly losing its value. International stocks have now outperformed the S&P 500 by the widest margin since 1999. And if this trend continues, you're either going to wind up really rich or really broke, all depending on what you do next. That's why we gotta break down what's going on.
If you go and just invest based off of what has been happening now, putting all your eggs in one basket, that's kind of crazy.
Well, and this is why we talk about long-term valuation metrics. Because in any given month, any given quarter, any given year, even any given stretch of 2 or 3 years, anything can happen. You've got to be very apprehensive about making lifelong decisions based on what's happened in the short run.
So when the market crashed in April, remember I told you about that person that I know that pulled out every single dollar out of the stock market. And now look where we are, back to all-time highs.
You know,
that was not a good decision. He's in his 30s.
I, of course, thought that it was the start of a big bear market, because every time there was a bear market, I think, yes, this is it, right? And I'm the idiot who thinks that. But when that happened, remember I said to you, I go, oh no, I really hope this is an indication it's going back up again. And sure enough, did I think we were going to hit all-time highs again? No. But these are the things. We have no idea what's going to happen. No clue.
All right, so before we talk about what's happening with the stock market, let's discuss where all of this begins, the declining US dollar. Now, even though this might sound like a sensationalized headline, I think we could all agree on one thing. Your money is going to be worth significantly less 20 years from now than it is today. And if you want to see just how bad it's become, check this out. Back in 1913, the value of $1 had the same purchasing power as $100 has today. And over time, your money just falls further and further behind.
And how much did you make in 1913 versus today? So let's look up what the average income is. I'm not talking about that. He's not sitting there saying, he's like, yes, it was equivalent to $100 today, okay? Let's look at the income. In 1913, the average per capita personal income was $333. So that same 333 is like 33,300 today. Guess what? In the US today, it's like 80,000. So we have still beaten. Yes, the dollar doesn't buy as much, theoretically. But at the end of the day, everybody's lives are better because our incomes are much greater than that devaluation of the dollar. Just don't listen to one small snippet. That just is totally misleading.
Like, if you just had $1 and held it for 100 years under a mattress, it would buy you the same amount today as a penny does. Essentially, even though the US dollar is seen as the world's reserve currency, there are currently 3 factors causing it to fall very quickly, with the first being money printing. Essentially, imagine our economy like a giant pizza. If you have 10 people and cut the pizza into 10 slices, each person has the rights to an equal slice. But what happens if the government comes in and cuts that pizza into 20 slices? Well, now all of a sudden, each person has half of what they did before. But then what happens if the government comes in and says, yeah, so we're actually going to cut that pizza into 10,000 slices, and your small little crumb might get cut even further if we need to divide it up even more.
Okay, fair. But I will say this. It's not like they're just cutting it. The theory behind printing more money is it spurs other economic growth. Or when we had COVID, printing the money out there stopped an even bigger economic collapse than we would have had. I'm not endorsing printing of money.
And it I want to say, encouraged people to take that printed money and go spend it and stimulate the economy in ways that was not happening due to shutdowns.
Yeah, we're not just putting the money in the economy and saying sit on it, and because then that wouldn't circulate through, it wouldn't cause the inflation. If you're sitting there saying, listen, I get what he's saying. I do think the pie gets bigger and your portion, your slice will get smaller, but the pie is still getting bigger and your portion is still getting smaller. It's not the exact same pizza size. That's the other thing that people are, again, I'm not endorsing that. I do not like the government printing like as they have been.
Well, that's basically what's going on with the dollar. And it's getting a lot worse. In this case, our national debt has recently surpassed $37 trillion, and we're now at the point of no return, because as government debt gets bigger, investors' concerns increase that their money will eventually get devalued, causing them to demand higher interest rates, causing the government to have to issue more debt, causing investors to demand even higher interest rates. Basically, there's no way out of it, other than printing more money and devaluing the currency even further during a time where fewer investors are buying it. Now, two, we have political instability. The fact is, right now, fewer countries are buying US debt because they're worried about the long-term health of the dollar, partly due to government debt, but also partly due to tariffs. In this case, the head researcher of Deutsche Bank said that the damage has been done. The market is reassessing the structural attractiveness of the dollar as the world's reserve currency and is undergoing a process of rapid de-dollarization. And to take this point even further,
that sounds very exciting and huge. Guys, I don't care if the reserve currency or not. Just like I don't care when China becomes bigger than the U.S. economy. Great Britain used to be the reserve currency, right?
Seems like they're doing okay.
They're still doing fine. Okay, I get it. It's still people want to be like, oh, we're king. Okay, guys, we're a large economy. It's going to be very difficult for us to outpace other economies. It's just going to be tough. There's so much more growth than China left, India, and don't forget Africa.
Recent surveys found that 70% said that they no longer want to invest in the dollar due to growing geopolitical risks, up from 31% a year ago. And third, money is going elsewhere.
Yeah, I think that's recency bias.
And why is the reason for that?
I mean, what we're seeing in the political world. Yeah.
People are sitting there saying like, oh, we don't like Trump. It's like, okay, fine, don't like Trump.
That's fine. There's no way that something can go from 31 to 70 something, and that's not realistic.
For example, since the US has abandoned the gold standard, the dollar's lost over 85% of its purchasing power, while gold prices have increased 85 times. And it's also highly liquid, lagging only the stock market. On top of that, Bitcoin is also gaining dominance, and when other options are available, less money flows into the US dollar, causing it to fall even further. Even JP Morgan called for a dollar reset, saying that the dollar's long-standing overvaluation is beginning to unwind, which could result in a 10 to 20% decline against major peers, such as the euro and Japanese yen, over the median term. We don't see this as a breakdown in the dollar, but it is a reset. Really, at the core, there's just no way to sugarcoat it. Our debt is continuing to grow, our dollar continues to get printed into oblivion, and eventually it becomes unsustainable. Now sure, the government could make an effort to reduce their spending, increase tax revenues, and make an effort to pay it down, but the more time goes on, the less likely it appears to be the case.
So this is my issue. He seems to say it like, of course they could. No, that is what they need to do. That is what needs to happen. If they do that, all of this stops. If they sit there and say, we're going to cut spending, we're going to increase taxes. Unfortunately, I hate increasing taxes, but it's got to be some combination of both. We'll get things in check. You know, I see people talking about 3% of GDP. Deficits should be less than 3% of GDP. Why not just have a balanced budget?
Yeah.
Or a surplus? People have to remember, surpluses. People always quote John Maynard Keynes like, oh, he's okay with deficit spending. No, he's okay with surpluses that then when times are tough and we have recessions, then you take those surpluses, give it out and have deficit spending to get things back on check. It's not just deficit spending. Oh, we have a recession, more deficits.
Yeah.
That's different. I don't like the fact that Graham's basically saying, yeah, they could raise taxes and cut spending. It's like, well, no, that's what would solve this whole problem. This would all go away. What increases the money supply? Having deficit spending, you have to print more money to cover for it. How do you stop that? You stop the deficit spending. How do you stop that? You increase taxes, you cut spending. Done. Move on. It's that simple, guys.
All right, now here's the part you came for. Is a declining dollar actually causing the stock market to go higher? After all, the stock market recently hit a brand new record at the same time that the dollar fell to its weakest level in roughly 3.5 years. So they have to be connected, right? Wrong. Didn't expect me to say that, did you? So here's the thing. When you look at the dollar's value throughout the last 50 years, you'll notice some pretty wild swings. Like it depreciated from 2002 to 12, and then it appreciated through the 2010s, all during a time where the markets went up and down and back up again, effectively showing no correlation between the two whatsoever.
Well, again, he's picking certain amounts of time. I do agree with them that it's not the reason why. But to look at that chart and say, proof this is it, it's like, hang on a second. Guys, you got to remember, the last 25 years have been an absurd 25 years in the market, going back even to 1870. Do we think, I personally believe that market valuations should be higher today than 100 years ago because it takes less capital to increase profits. 100 years ago, if you wanted to make money, you had to build a factory, you had to do all these very expensive things to generate cash.
Lay a railroad.
Yeah, you have to go, exactly. You have to go build a freaking railroad. You have to have land. You have to go all do these things. As we're less and less manufacturer based, we're going to have, look at Instagram. I think it had 20 employees when they sold for $1 billion. Mm-hmm. What would a company have to be, how many employees they have to have back in 1925 to be worth $1 billion?
A lot.
A lot of employees, tens of thousands probably. That's the difference. And that means that if you can generate extra returns and extra cash with lower amounts of capital, you should sell for a premium. Now, with that said, stocks versus the dollar, I still want to see what more he's saying, because this is where I'm going to sit there and go, valuations, guys. Valuations. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Right now, the voting machine has been saying, put money in stocks. Everything is good. That's what the voting machine is saying in the short run. Yep. The long run, what's going to happen? He said earlier that, what bank was it? Morgan Stanley or Deutsche Bank says that the next 30 years are going to be below average returns. That's hard to hear that's being said. And by the way, we've said before, apart from the US, the rest of the world is pretty fairly valued. So it makes sense that if you have overvaluation here, fair valuation here, which one would do well in the future? The more you pay for something, the lower your returns. The less you pay for something, the higher returns.
Yeah. Now, I will say this about Deutsche Bank and all the banks. They might change that next week.
You're 100% correct. You're 100% correct.
I loved seeing, I don't remember, maybe it was JP Morgan. They were saying a recession is imminent or something is imminent. And then the next week, the tariffs, something happened. They're like, just kidding. We're good.
Banks are as fickle as anything out there. Yes. They change their viewpoint because guess what? Too. They have customers and they want to make sure that they're just staying right in line with the market. Here's what happens. Market goes here. They're right after to say, this is the follow. Market goes here. They're right after to say, oh, look this response here. They're just reacting to what happened most recently in the markets. Yeah.
So again, don't take that snippet.
Yes. News follows the stock price. Yeah. Let's continue on.
Fisher Investments also analyzed this phenomenon going all the way back to the 1970s when the dollar was taken off the gold standard. And wouldn't you know it, they found that the correlation between the trade-weighted dollar index and the S&P 500 returns is only about 0.15, which is essentially zero.
Now, going back to 1974, this is basically no correlation. Okay. This is a lot longer viewpoint. This is 50-some years, 51 years. This one I'll buy into. Mm-hmm. Going, okay, 51 years. At which point we saw stagflation, massive boom, collapse, massive boom again. Okay, we've had some stuff happen here. And in 1980, I think we had like no debt basically in this country, and now we have 37 trillion. Right. I can buy into this one.
So here's how you could protect your money. 1, don't hold on to too much cash for too long. Now, that's not to say that you shouldn't have an emergency fund or some money on the sidelines while you save up for a big purchase.
But when you're holding on to cash, you're still investing it in an interest-bearing account. I have a savings account at U.S. Bank that pays me 3.75%.
It's not just sitting.
It's not just sitting. Yes, it's cash there, but I'm getting a return on it. When he says hold on to too much cash, I literally hear 0% and greenbacks, like literally holding cash in your pocket. That's not what you're doing. If you have a 0% account, then yes, you're doing that. But when you say don't hold on too much, I hold on to cash. It's getting 3.75% at U.S. Bank, and my 90-day treasuries are 4.2%. Yes, if they lower rates, that'll be lower. Yeah, that's a little misleading again.
But it is to suggest that you probably shouldn't stay out of the market for many years in a row. Otherwise, you're likely going to lose purchasing power. 2, you should diversify your investments throughout as many different sectors as possible. The more you spread out your money, the more you reduce your risk and volatility. That way, should one market fall, the others should more than make up for it. 3, ignore the negative news and keep buying it. Study after study shows that the best thing you could do is stick with your plan, keep buying into the markets, and hold without panic selling.
This is 100%. This is the real point of this video. I'm going to say this is the one. This is the one you cannot do without. You have to continue doing this. Listen, everybody knows that I'm 80% cash and 20% stocks in my brokerage. My brokerage is only 25% of my net worth. The rest is in real estate and businesses. And even the money in my brokerage, I'm starting to take my cash out and buy more and more real estate. Because I look at it going, if I can't find good value here, I got to find it somewhere. And I'm finding it in real estate deals, surprisingly. You got to continue investing. And by the way, for the rest of the cash I have, I'm okay sitting on, what is that? How much of my 20% of my net worth making 4.25%. The rest of it's all making 10+%. Mm-hmm. I'm good with that. Mm-hmm. making 15% in a lot of cases. Why? This is exactly, you got to continue investing in something. And guys, don't jump from investment to investment.
No, don't do that. It's not going to work out.
Yeah, it's not going to work out well. If you want to add international, find a way to invest internationally and continue to do it forever.
4, keep a steady income. I've said this before, but the biggest risk I see is that a drop in the stock market is usually correlated with job losses and a reduction of income. This is why it's so important that you do your best to keep a consistent income, to keep buying into the markets, or at least pay your overhead expenses so that you don't have to dip into investments. 5, it's probably a good idea to stay at a margin and debt. I think it's pretty safe to say that you're playing with fire anytime you borrow money for the sake of investing, so it's probably not worth it.
If you borrow money, here's what I agree with. Don't take on debt you don't need. Don't buy stocks. Don't borrow against your stocks to buy more stocks. Don't max out your, if you're going to do margin, I use margin to buy real estate. I only borrow 25% of my portfolio. So I'm borrowing a very low percentage, which means my stock has to fall in half. And 2, I'm buying an uncorrelated asset. I'm buying something that generates me cash flow, pays down debt, and grows over time, no matter what the stock market's doing. That has been proven over time, except for a small blip of time between 2005 and 2012, right?
Yeah.
Same with steady income. Hey, you know what? Instead of keeping a steady income, yes, keep a steady income, save 20%. Make sure you're saving and not spending more than you need to spend. Because having a steady income is great, but if you spend every penny of it, you're going to be hurt.
What's the purpose of the income?
What was that?
What's the purpose of the income?
Yeah, you're going to be hurt at some point if you lose the job or the economy takes a step back. Got to remember that.
Finally, 6, if you need money over the next 2 to 3 years, it's probably not a good idea to go and invest it. A few years is just not long enough to ensure that you're actually going to make money.
Beautiful. Thank you. I love this. I don't think people talk about this enough.
No.
People say, hey, Mo, I'm gonna buy a house soon. I'm gonna put the money in this. Why? When are you gonna need the money? In the next 5 years? Then don't put it anywhere. Put it in your 90-day treasuries.
Just let it grow slowly.
Yep. And if you want, do it in five-year treasury. Just make sure you don't touch it for 5 years.
Right.
But do the 90-day treasuries. There's no reason to invest your money into volatile assets in the short run or illiquid assets.
Yeah, especially illiquid.
Well, and even volatile ones.
No, both of them. Volatile illiquid would be the worst.
What's volatile and illiquid?
No.
That's great. Let's keep going.
And as you've seen throughout history, there have sometimes been decades where the stock market doesn't recover.
But look at this, Mo.
Yeah, look at
1 month T-bills from 2000 to 2009. And today, guys, this was overvalued about 50 to 55%. We're currently at 115% overvalued. I'm not saying this will happen again, but if I were a betting person and somebody said to me, what's going to outperform treasuries or stocks based on today's valuations, I would bet treasuries. Doesn't mean you should sell things because we don't know. And as stocks go down, you're going to wish you were putting money in the market right here. And even though the market went sideways like this, guess what? You would have bought at an average of this and still been profitable and still collecting dividends along the way. That's why it's important not to worry about those things.
So the shorter your investment time frame is, the less likely that money should be in the markets. At the end of the day, all of this is just about protecting your assets and making sure it grows long term without losing value.
That's impossible. You're going to lose value in the short run of things. You know, we talk about this, like I'm very diversified. I have apartments, I have businesses, I have stocks, I have cash and all that stuff. So I haven't seen my net worth go down in a long time, right? That's a fluke because of my ability to have these assets, right? Mo, I think the same thing's for you because you're trading along the way as well. So you're not necessarily correlated with the market.
Kind of.
Yeah, whatever. In a sense. So I don't know that you'd call that a hedge. That's not for most people. Now, if you're saving a ton of money and you don't have a lot, yeah, it's less likely that your net worth's going to go down. Like, you know, my stepson, he might be worth $50,000. Okay. What are the chances that next year he's worth more than $50,000? Probably pretty high because he's going to save money, he's going to earn income, all that stuff, right? But if he was worth $50 million and he wasn't investing more and he was maxed out on his income or not making income because he's retired, it's more likely he's dropping. These are the things you have to consider. But for the most people watching here today, as long as you're saving and saving a nice percentage of your income, keep doing that. Your net worth can still go up, even with drawdowns in the market.
So in terms of what I think about this and what I'm doing with my own money, I'm going to be honest. I do have serious concerns about the value of the US dollar in the long run, but I also don't expect it to collapse anytime soon. Like, the reality is, it's still the reserve currency of the world. It's still predominantly used throughout global trade, and I don't expect this to stop anytime soon. However, we cannot deny the government spending is out of control, and there are so many alternatives now to the dollar that are gaining a lot of attention, like gold, Bitcoin, and other world currencies. For this reason, I do not think it's worth it to completely restructure your entire investing philosophy over a concept that could take decades to play out. But I do think it's worth it to think strategically about what you're doing and hedge yourself.
People say strategically all the time, though.
Mean?
Yeah, exactly. What does strategic mean?
I mean,
because a lot of people sit there and jumping out of investments saying that's strategic, and we look at it and go, that's stupid.
That's stupid, yeah.
I don't know. Listen, I think Graham Stephan does a great job of breaking some great concepts down. I agree with the majority of this video in terms of what he's saying. The cause of it, though, I think you guys have seen, I've said, look, wait a second, this is all caused by one thing, government spending. That's it. At the end of the day, that's all it's caused by. And if we increase taxes and don't cut spending, you're taking away from further growth because you're disincentivizing people from investing more. If rich people are greedy and you give them a reason to not invest more because they're greedy, that's not a good thing. You want them to be a little greedy. You want them to sit there and say, I want to make as much money as possible. But if you tell them, hey, we're going to tax you 95% on every dollar you make above to tackle this growth, this problem we have, you're going to just stifle more and more growth. That's it.
And job loss.
And then that leads to job losses, exactly, which hurts America. There's a few people out there, and even if you tax them 100% on their net worth, it's not going to stop the U.S. debt problem. We have a spending problem, not an income problem.